In this video, we're going to go through one price action process that works. It can be used on multiple timeframes for day trading, swing trading, and long-term trading. It will work on different asset classes, options, stocks, and futures. The one thing that we're always struggling with, and the one thing that we always want, is profitability and making money. Constantly going through other ideas where we have information overload, not having the right tools. We're always looking for that consistency, opportunity, and decisiveness in our trading. That consistency is what leads to profit. This is one that I have used over 20 years, and I have found great success with it. It's one tool in the toolbox. That's all it is. But for 20 years, I found massive success, so I want to walk through it. So we're going to walk through it from entry to exit, from the exact way to enter, from the exact way to exit, and I'm going to show you a real life example of this as well. The very first step is identifying the trade. For our example that we're going to use something that we actually day trade. You can use this for swing trades, you can use this for long-term trades, it doesn't matter. But in our example, we're just going to start with a 1-minute chart, and we are going to go to different time. I want to show you exactly what I did to find this idea and then where I knew where the entry was. So the very first thing that we do is mark off critical level, and they're going to be recent highs and recent lows of the trade. And it doesn't always have to be the ultimate low. It will become what I will refer to as a pain point. In other words, a place of interest. Pain point could be a FOMO where you sold, fear of missing out, or where you bought up here and then you come down and now you have another area of interest. And what you're doing is you're marking off these areas of interest and looking how you acted there last time and then how you're going to act this time. You don't know, but they become places of interest. Once you have those marked on your shorter time frame, if that's what you're looking at doing, if we were looking at this for a shorter time frame trade, so when you come in, you are already prepared for the day. And this is really important, especially for newer traders. You must prepare the night before for trading. If you're not prepared when you come in, you're not going to be able to react as fast as someone else. This puts you at a huge disadvantage. I find gap ups, gap downs, excellent spots to also put these because they become a place of interest. This is a pain point. Somebody would have bought here, rallies up, and now they're dealing with a gap down. This becomes a place where someone will look at this, and as a pain point, they will take advantage of this and they will get out of the trade because now they are, quote, break even. And you can see it begin to battle that specific level, probably specifically for that area and that reason that I just pointed out. Once those areas are marked on your shorter time frame, you can then go take a look at longer time frames. And in our example here, I'm looking at how those 1-minute bars fit on a 5-minute chart and seeing if I see anything out of place. Here we are in a 15-minute time frame, and you can see how decisive this area has become, all from starting with a 1 and then just drilling into longer time frames. Here is an hourly time frame. And as we know in the past, wicks are price rejection. We went through this in a previous price action video, which I will link at the end of this one as well. We can see the price rejection throughout this level right here. And we know now that that is a major area of support. So to reiterate, we started on the 1-minute and then we went through different time frames to see if we could get a clearer picture. And for our purposes, we can see very clearly that this has become a major support area. Now, one tidbit I want to add to this. I always want to trade with what I consider the trend. So I would overlay this with what is the underlying index doing and what is the underlying stock doing and what is the underlying sector doing. Meaning I would look at index, then sector, and then stock. And what this is going to do for me is it's going to allow more chance that I'm right. By aligning myself with what's actually happening in the index, sector, and stock of what you're trading, even whether it's a day trade, swing trade, or long-term trade, options, stock, futures, it truly does not matter. When you're aligned, the probabilities of success will go up, and we are fighting for inches here. We are not fighting for yards. Really important to get that. In this particular case, we have seen lower highs. And as we're seeing these lower highs, we're seeing any attempt to get over these lower highs becoming rejection. This allows us to know that we have pricing pressure on the trade. At the same time, we can see support over and over in here. In this case, we have 7 times where we've hit this very specific level. Therefore, if we broke this level, it would be a break of a major support line, and that would lead to more pressure. So what we've done is establish 2 major points of interest. The first, to see if the trend is going to change. The second, to see if support is going to hold or it's going to break. Once we've identified our target area, we watch how the stock acts at that specific area. In this example, we can see a test right here towards the end of the day, and then a rally into the close, followed by rejection. Short-term traders will find it extremely helpful to mark off previous day closes. What this has done is provided us an opportunity. We have now clearly defined our area of support and the previous close, as well as where this trade may or may not break out of its recent downward trend and selling pressure. The next day when the stock opens, it retests this level, allowing us to note that it's still holding. Most traders will buy that bar up and use what is called a 1-minute orb or a 1-minute opening range breakout trade. This is a strategy that I'll implement as well. The difference is there is a right time to do this and there is a wrong time to do this. The wrong time to look at 1-minute opening range breakout strategies is when the stock, sector, and index are in pullback or correction modes. Institutions are fully aware that retail traders do this and they take advantage by selling into them. Nothing could be clearer than this. Once the 1-minute orb is broken, opening range breakout, you have this bar form. Once this bar forms, you will see that this body completely encapsulates that body and that this red bar is eating up some of the wick. Remember, wicks are price rejection. When the wick starts getting eaten up by sellers, that is telling you that people that were not willing to sell here are now willing to sell. Once this closes and confirms that that is the case, the next bar is your lower low of that low. The lower low of that low is your entry. Right there is your entry. The top of this bar is your exit. Why? Because this is what triggered the possible trade. All of your exits on all of your trades should be around one core principle. Did the reason I get in the trade negate? And if you use that as a defining principle for all your trades, you will find that it gets a lot easier and you are able to get rid of some of your pain points, such as inconsistency, because your losses will be less. You will have a definitive reason on why you're getting out of the trade. For example, if I enter here and then I close over this level, then it's going to put me in a position where what I thought was going to happen did not happen. I have to objectively assess that and then just move on. In this case, the trade worked and we entered. Once the trade breaks down, we begin to look at the position. In this case, we bought puts and shorted stock. Once this happens, we are already looking, and again, this depends on your time frame, we are already looking to start locking in profit. And then as it's pulling down, we are getting out of the trade. This is very signature of how I trade, where I want positive slippage. I want to get out when everybody's trying to get into my trades, because that allows me to get positive slippage, meaning I get better fills on my sells. For example, the person that is getting out of puts here versus getting out of puts here will have a much different risk versus return profile, even though you're right around the same area and price. Just because my fills are going to be much better here than they will here. And that because I have buying pressure on this bar where I have selling pressure on this bar. Buy when they sell, sell when they buy. If you do that, you will find out that your performance will look considerably different. I really want to hammer this point home. Every trade that you're doing, focus on whether or not you're getting what I refer to as positive slippage. As the trade continues to break down, scaling out on the way down, taking advantage of positive slippage. Eventually, we start getting near a support line. Once you have a definitive support line, you want to pay attention to it. Now, there is some significance here on how would you define whether or not that has the probability of holding. There's a couple ways to do this. You could look at a varying number of indicators, but there are also very clear telltale signs. Number one, reversal pattern. Nothing speaks to a reversal pattern like a bullish or bearish engulfing. You can see you have one practically here. Now, for purposes of this video, I'm going to assume that you know what these are, but if you don't, it's just very clearly when you have a red bar and then that green bar completely encapsulates its body there, and that was not the case here. I look for the body encompassing, very similar to how we entered here. People would say this is not a bullish or bearish engulfing because the bodies don't confirm, meaning you don't have the full wick, everything. For me, it's the body. It's the actual body. The breakdown and reversal of not flipping that. So when I see this and I see bottom tails like this, now how do you define if that is a bottom tail of interest or not? Well, I've been doing this a long time, but I can tell by looking at that where I'm at. And I'm going to give you a really quick way that you can use on all your trades to determine that. And what I would suggest is it's a lot easier on longer time frames. But if I take a 50% line, and you will get more proficient at this with time, and I'm at a 50% line And that wick, look where it falls. That's telling me that this bar is neutral at best. Any of these other bars that I would do that with, you can see that I'm not at a 50% line. Any of them. You can see that here, then you get the bar down, you get the negate, and then what happened? Here, you get the bar down, 50%, you get, I'm over encompassing that bar, and then you have here. This is a clear indication that your trade, your party might be coming to an end, for lack of a better term. And then what you do, what I do, is I will mark off this area of interest and I will look at that. I am defining this area of interest by this pattern and the fact that I am near a level. Let's take a look at a longer time frame for a second. Now, so far, what have I marked off? I have not shown volume because we already know we're going to have a lot of volume off the open. I have not used any other indicators except read price. What we have down here at that 50% line, and where this always gets fascinating to me after the fact, is you can take that 50% line from your shorter time frame and look at a longer time frame and see how you reacted to that area. And you can see at that area as well that this became a place of interest. And it also ties directly into what we marked off as a low and another area of interest. This would give you pause. So far we have our entry, our ability to scale out into positive slippage, and our ability to denote areas of interest where the trade may be coming to an end. At this point, if you're looking for something else besides just price, but I would argue that price is more than enough to tell you that the trade's probably over because this is your demarcation line and now you flipped it. At this point, we would be exiting the trade. That said, if you're looking for more color without getting into all fancy indicators or oscillators, you could simply overlay a 9 EMA. I get asked a lot for specificity. So when I use a 9 EMA, I am using the open, high, low close. And you can see very clearly here that you have not just one, but two closes over that 9 EMA as well as over. And that might give you more conviction that the trade has come to an end. It's really important to note this. You don't know that you're not going to roll back down and go lower. Nobody knows what's going to happen. What your goal is as a trader is to take the majority of the move out. And by taking the majority of the move out consistently, that will help you become more profitable. This is one tool in the toolbox. Let's watch this play out live. Nasdaq's toast. Nasdaq's dropping like a stone. So NVIDIA dropping too? Yeah, NVIDIA's already dropping. So just watch here, watch that level where retail is. But to me, it already seems pretty obvious what's going to happen here, but maybe it's not obvious to everybody. Let's go take a look at NVIDIA. We're the 120s. They're $1. I'm in 120 or they're 30s. You were just there. I have a position in the 120s on NVIDIA. I paid 130 for them, 135. Too. There we go. So what's going on with those NVIDIAs? So they're at 175, $2. See how ugly this gets? Yeah, right into there. I'll probably close some. All right. So right in there, I closed some at $2, 199. It looks like NVIDIA bounces here and you don't like it. That'd be where you would cover it. Bounces here and you're not, and you bounce there. Probably not the worst spot to look at it and say, okay, well, maybe I should cover some, right? If it bounces here, if gonna hold, I don't see how that's holding. How is that gonna hold? I don't see it. But let's watch. Let's go take a look at NVIDIA. What are you doing? There you go. Go to your home. We got a double there, up 100%, closing some. NVIDIA puts $3. I got these things so cheap. Trimmed. I think my party's coming to an end. Where's my party going to end? Probably there. 118. Probably bounce there. Well, straight down's not really a pattern, right? Where am I? $3. Don't bounce. Not yet. Don't do it. Trimmed. 275. Now we're going to have to watch. Is that enough before you bounce all the way back up? Maybe. So I got to watch this level because that might be it. So I'm just watching this level. If you start flipping, retest that level, that's probably the easy money's made there. I just drop a 9 in and just watch the 9 for a minute. And let's put that on a 1. First close over. So maybe you're going to do something here. Let's just watch for a second. And then I'll trim and then I'll put the rest at break even. All right, that was a fun trade. So the rest of those are now break even and I trimmed more. Now I hope you found that helpful. If you're looking here, you should now be able to determine an entry, know how to mark off key levels of interest, how to scale out of this particular kind of trade via puts, or if you're short stock, how to use this on multiple time frames, how to mark positions of interest where the trade may be coming to an end. I also think the live example is a great way to see it and watch how fast it plays out. And this allows you to see exactly how I'm doing it when we're doing it in the community. You can see it live and you can see how fast that action actually is and why you need to be prepared for this. If you like this one, you might want to watch the next one.